Greetings, fellow investors. I'm Matthew Cochrane, a lead advisor with Seven Investing. And today I am joined by my co-lead advisor, Anirban Mahanti. Anirban, how are you doing?
I'm very good. It's nice and bright and not too hot, not too cold. So I'm very happy.
All right. Excellent. Well, look, today we're going to talk about two stocks that I personally own. One is a very large position for me. The other one used to be a large position for me, but isn't so much anymore, unfortunately, because the shares have come down quite a lot. Those two stocks are Alphabet and Meta Platforms. And Anirban, do you own these stocks?
Well, I have now, after not owning Alphabet, I've got synthetic positions in Alphabet. So I don't actually directly own them, but I do synthetically own them, which other words means I've got options positions, which gives me long equivalent exposure to Alphabet. So I do own actually. So you could say I do own some Alphabet. Meta platforms, I would not touch that platform with very long poles. So at least not yet. But yeah, I'll caveat. I never say never. Uh, so yeah, maybe is the answer.
My sad history with Meta Platforms, which is obvious, which used to be Facebook, is that I started buying this company back in 2015, and for a long time it did very, very well. And now all except like my very first purchase of it is in the red, because I've dollar cost averaged into this for several times over the years, and so like I'm now overall I'm down in my position, and I started buying this stock like seven or 8 years ago. So it's been a minute.
Can I gloat a little bit on this? So I'm going to gloat a little bit, and this is where sometimes what is it called? Luck shines on you. So I think I bought Facebook in 2012, or right, it was very soonish after IPO when it crashed from whatever $40 to like $25. I actually averaged on the way up. Um, and then when the Cambridge Analytica scandal happened, that's when I sold all out. Basically, my indications were this is not good. Apple was tightening on privacy, and in my mind, privacy was a really big deal that I think would become an even bigger deal over time, but it was not yet recognized as a big force at that time. So I actually made a lot of money on Facebook. So thank you, Zuckerberg, for that. And I got out, and so far has worked out well.
Yeah, so far that was a very good decision. Shareholders of Meta, which is like I said, is myself is included in there, have had a rough year. Shares of the social media giants have tumbled more than 70%. That's 70% year to date. That was only exacerbated when the company reported its third quarter results, which was, as we're recording this, about a week ago, and about the time the listeners are listening, could be closer to 2 weeks. The numbers paint a harsh story. Revenue fell. Here, actually, we have some of these. We have some of these screens we can share if you're following along on YouTube. But the numbers revenue fell about 4% to 27 point about $27.7 billion in the quarter. This is advertising revenue, which is like 99% of the revenue. That's okay. It fell 4%. That's a range of macro factors, lapping some tougher comps from last year. There's a range of factors there. I'm not too worried about the revenue falling. The problem comes with this net income. Net income, earnings per share fell 49%. Net income fell 52% to $4.4 billion. That's from a year ago. That was over $9 billion. That's a concern. R&D and operating expenses are, they continue to multiply as CEO Mark Zuckerberg continues to sink money into his metaverse projects and AI and ML capabilities. There might be some good news after all that bad news, and there's a lot of bad news, but there might be some good news that the platform still isn't losing a lot of users. Anirban, what's going on? What's the meta with Facebook?
Well, you've already highlighted. So basically, the company Meta is spending even more than like a drunken sailor would. It's spending basically everything that it can and more into various things. Now, I think a couple of things that are happening. One is that it seems at a high level it might be easy to say, oh, they're spending all of this on, the metaverse. But I have a different take on this. I think they are spending maybe about 50% on trying to get to the metaverse, and the remaining 50% to actually hold ground. And so here's a curious thing, right? Every conference call that I read, whether it is Alphabet's or whether it is Meta's, they all seem to say, "Oh, engagement is fine," right? Their engagement is not suffering. But we all know that TikTok and other applications are really, the cause of a lot of the current pain. So if their engagement has gone up, somebody's engagement should be going down, or somebody's engagement kind of should suffer, right? So one of the ways to think about it is that, maybe it depends on how you're measuring engagement. The good engagement maybe is down. That's one way of looking at it. And the reason I suspect this, my suspicion is this, that, my thinking has some validity, is that the word I hear on the conference call is we are spending on AI infrastructure. To me, that means you're spending in a lot of, NVIDIA hardware, a lot on software. Your R&D expense for Facebook is it's gone up like crazy, and it's going up like crazy, which means you're really hoping that that you can catch up with so that there's a brilliant chart. Look at this, 33% of your revenue is actually now R&D, right? Versus it used to be 20%, 22% in 2020. That's a huge change.
Yeah, R&D just
it's
rose to $9.1 billion. That's a 45% increase year over year.
Right. So, and it is, a lot of this is being talked about as I said, on this AI infrastructure. To me, that means is they are all trying to play, these platforms are trying to play catch up with TikTok in terms of TikTok's ability to recommend these short form videos that's keeping people longer and longer on the platform. And this is just AI catch up or recommendation engines or whatever you call it. It's not actually fancy AI. They're not really solving, artificial general intelligence or anything like that. They're actually just playing catch up. That would be my guess. I would say the same story actually applies to some extent for, YouTube and some of the AI expenses that Alphabet is taking on. I think they're, to some extent they've been caught, maybe you're just doing caught double surprised by TikTok. That's my guess. I'm just taking a guess here because nobody's going to say this, but that's my guess, and that's what's happening. And then the other aspect, is the spending on sort of the Meta platform, and the 4 or 5 different things that are happening there that Zuckerberg talked about in the call. We can cover that later. The one thing you mentioned high level data points. I think the most scary data point to me from Facebook's report was basically free cash flow was zero, right? Free cash flow has basically collapsed completely. So, and that's why the shares have collapsed, is the enterprise value is basically the sum total of the future free cash flow. Basically, right now, it's very difficult to yes, that's the chart. So
yeah,
this is what
so if you're listening, we're showing their free cash flow reconciliation over the last several quarters. This quarter, it came in at $173 million. A year ago, that was $9.5 billion. So to Anirban's point, that has pretty much just disappeared. And Anirban, that is due to the CapEx. I mean, the CapEx spending is just off the charts. A year ago, year to date, in 2021, at this point, it was CapEx was $13.7 billion. This year, it was $22.8 billion. That is a significant increase in CapEx over the last year.
Yeah. So, and just to go then because we have got this slide around that point. I mean, one of the things to think about here is that CapEx, a lot of this CapEx, I think, is hardware. They're basically spending on data centers, right, and stuff that they're putting into a data center. So it's hardware from Arista. Some companies are actually benefiting. Arista Networks, NVIDIA, lots of servers are going into their things. The thing I ask myself is that this is really, to me, is this, future expenses or, catch up? I think it's catch up. The other thing I think about when I look at these numbers is they have no real way of amortizing this other than right now on advertising revenue, right? So this is not, and again, compare and contrast with Alphabet. When Alphabet is putting in this, infrastructure and data center, it's actually going to try to, make up for some of that via, say, GCP revenues, right? So Google Cloud Platform revenues are actually going to be, they're going to be able to basically have multiple uses for the infrastructure they're building. These guys, Meta only has actually one use of that infrastructure, which is effectively to generate advertising revenue. So I think there is something there about how the capex is working and what the utility of the capex is more limited, and therefore they need to really be right on those things that they're betting on to get the full benefit. Otherwise, from the call when I was reading, they really don't know. As they said, multiple times, their CFO and or the outgoing CFO and the incoming CFO and Mark Zuckerberg, they said you don't really know. I don't think they understand. The word of return on investment was unclear to them. They're just investing, which again, to me, reinforces the point that this is catch up, and they really don't know whether there's going to be return on investment on these things.
Yeah, that's an interesting point. So let's just go through the numbers real quick. This year Meta plans to spend 32 to 33 billion dollars in capex. That was largely expected. I think what caught the market off guard was their eye-watering capex for next year, which was 34 to 39 billion dollars. So it's going up again, right? So and they were like, eventually, we think capex is going to decrease as a percentage of revenue over the long term. All right. But that's that doesn't do much for one, what is the long term, and two, how much is it going to decrease, right? So I do, there's a lot of uneasiness there. In 2023, Meta estimates its total expenses will be in the range of 96 to 101 billion dollars. That's like, if you take the midpoint of that and you take the midpoint of this year's projected range of 86 billion dollars, that's about a 15% rise. Next year's estimates include some one-time charges, such as $2 billion for consolidating office space and things like that. But a lot of it comes from its growing headcount. So Meta now employs a workforce of 87,000. That's a 28% increase year over year. And a lot of next year's rise in operating expenses are coming from the hires that they made at some point this year, who next year will get that, a full year salary. The good news on that front is that, the CFO, Dave Winter, he kind of said, look, our pace of hiring has slowed in the third quarter, and we're done hiring. We expect our head count now to be basically the same at the end of 2023. So that's something, for shareholders to look at. Like we said, we already talked about R&D. That rose to $9.1 billion. That's a 45% increase over last year. I mean, so these numbers are just they really are eye-watering. I mean, and as a shareholder, the guidance for CapEx and operating expenses next year was kind of like a punch to the gut, to be honest with you.
Yeah, so I agree. So basic.
Oh, sorry.
Yeah, go ahead, please.
I was just going to say, so now I think, shareholders, I think, just really need to ask, are these costs worth it? I have a few thoughts on that. Zuckerberg says the company is focusing its spending on a small number of high priority growth areas. That includes, one, its AI discovery engine that powers what its platforms recommend to users. And then its ads and business messaging platforms. And then third and final, his vision of the metaverse. So I think, if you're a shareholder, you go through those three things and you figure out, are these things worth it to spend on? So I'm on two of them, and I don't want to, give it away, but on two of them, I think it is worth it. And I think they have to do what they're doing. The third one, the metaverse, I'm still really not sold on, but the AI discovery engine, right? Engagement trends on the family of apps, which is Facebook, Instagram, WhatsApp, and Messenger, they do seem to be strong. They're not dying platforms. Dave Wenner, he said that the aggregate time spent on Instagram and Facebook is up, and that's both internationally and the US. Zuckerberg said they have data that indicates they're gaining market share on TikTok. More than 140 billion Reels videos are now played daily. That's a 50% increase from just 6 months ago. Reels are shared 1 billion times a day in the DMs on Instagram alone. Anecdotally, I will say I contribute to this. Like I mean, I've said this before, but I got Instagram just to kind of monitor my my oldest account when he got an Instagram account. And I got on there and I didn't understand at all. I felt old. I'm like, I don't understand any of this. And I never really got on. And I would just periodically check on his account every few months. And then like once I went on and I found a reel and I just started watching reels. And that used to be all I would do on the platform. Every once in a while, just watch some reels. Now I'm probably on every day. And not only do I watch reels, I'm on the stories, I'm going through the feed, and the AI discovery engine, seeing it works for me. They know what I like and they send me that content. That's one person in a fraction, but just anecdotally, that does make sense to me that it's discovery engine seems to be pretty good. Here's a quote from Zuckerberg. He said, "Our AI discovery engine is playing an increasingly important role across our products, especially as advances enable us to recommend more interesting content from across our networks and feeds that used to be primarily driven just by the people and accounts you follow. I expect a few things to set our products apart here. First is that our discovery engine work allows us to recommend all types of content. So it's not just reels. That includes photos, text, links, communities, short and long form videos, and more. And second is that we can mix this content alongside posts from your family and friends, which can't be generated by AI alone." So I'm going to say, like, on that level, like Anirban, so like Apple changed their iOS policies last year and they finally lapped that. But that basically takes a 10 billion chunk out of their revenue a year, right? Like that's what they estimated it to be. So given that, Facebook had to improve like what it knew about people. And if the way to do that is to invest heavily in AI, I don't know if that's a bad bet, as expensive as it is.
Yeah, so I don't disagree with you. So how do I put it? So as I sort of indicated earlier, to me, saying that if I'm going to spend on a recommendation engine billions and tens and tens of billions of dollars on recommendation engine, that just tells me that you've fallen behind and you're just playing catch up. And that's just a plain and simple. So right now they have, like, my favorite thing to say
they
is,
fell behind or that Apple changed the rules?
no, so that's different. So Apple changing the rules is more about sort of recognizing the return on investment on advertising. So that's different in my view to pushing people stuff based on, so that the investment on AI infrastructure has got nothing to do. That's not the ad measurement engine or the efficacy of ad. That's separate investment that they're making. I think that's a much smaller investment compared to their AI. Their AI investment is basically pure catch up, in my opinion, with the other big thing called TikTok. Yeah, that's my guess. Nobody's going to say this, but I think that's what it is. Sure. And in a way, like I've always said this, like, they're basically the Yahoo of the modern generation. They have no choice but to kind of do this because if they don't, they're dead eventually. And if they do, they maybe can live, right? So and how well they can, but it's going to cost them a lot of money to get there. The things, I think, from an investor's point of view, a couple of things to think about, right? You have to. So one of the things you have to think about is, what is the normal cadence of expenditure that this company is going to have to actually generate content, make enough recommendations that people stick to a platform, spend enough time. Now, if I take a very, very meta view of this, then one of the bigger problems they've got, and it's not, I think, its growth days are basically over, right? So I'll come to that point now and explain why I think its growth days are over. It's basically got as many people as you can potentially have. If you think about it, it's got like 180 million whatever people on the US. That number, or 170 million, that number has roughly been flat or is, you know, a little bit up, a little bit down. Numbers are declining in terms of its exposure to Europe, right? And the rest of the world, it is gaining, but that's not really a big ad market. So you can gain a lot of people's time in those markets, but those are not actually generating significant ads. However you look at it, there is a finite number of people that are going to be on these platforms. There's a finite amount of time people are going to spend on these platforms, and everybody's competing for those amount of time, and
That
therefore
time is really
proportionately,
valuable. That time is
and
really valuable.
that time, right? And there is constantly new applications and new things and new fads coming that is going to compete. So there's always going to be some investment needed and some steady cadence investment. In other words, it is going to be very difficult for them to significantly grow the ad revenue from the platform without destroying experience. Like, I mean, you can stuff more ads, which is going to destroy your experience, or you'll have to do more commerce, which might destroy your experience. I think there is only, you can get so much growth once you have sort of hit that saturation level. So they're basically at a saturation level in terms of users, right? And it's competing for time, which is really hard when you've got all these other platforms that people are interested in because it's the current fad and things like that. I think that's the challenge they've got, which means that they have to spend heavily, and B, which means that they need to find the next thing, which is why Zuckerberg is using. He's doing the right thing in a way, because he's seeing that, well, this is saturated. There's got too much competition. There's only so many dollars you can win. There's only so much time that you can get. There's so much scrutiny. It's very hard to compete. It's anybody can write an app because it's an application layer, and so you got to spend on other things, right? So and I think that's just the longer term story here for Facebook, is that the growth days, in my opinion, basically gone. And if you think about growth days in just not even in terms of revenue, but just in terms of free cash flow growth, it's just going to be very hard to see free cash flow growing steadily without constant investment, right? So that brings us to then the next piece that they're spending on, which is the metaverse.
Well, hold on.
And
I'm
I'll
going to
pass
save
it
that
back
for
to
last because the next one is their ad and messaging platforms. So there's three they listed. We did the first one, the AI discovery engine, but let's do the ad and messaging platforms next. All right. So Apple's iOS policy changes last year. They took like a $10 billion chunk out of Meta's annual revenue. That's how they estimated it. And a lot of Meta spend is now going to improve its probabilistically based ad targeting model. So there's a few things they mentioned. They talked about Advantage Plus. That's a product that is, quote, enabled by machine learning that helps clients test, learn, and optimize their campaigns faster. While acknowledging it's early in the game, management stated that a recent test saw a 32% increase in return on ad spend for advertisers using the tool. For what it's worth, I've reached out to a few online advertising agents I know, and if they've used this, yes. And one of them got back to me and said, like, he did use it, and it was a very positive experience. Messaging was another major revenue stream opportunity with click to messaging ads. These allow businesses that run ads on Facebook or Instagram to communicate with customers directly on Messenger and WhatsApp. They're at a $9 billion annual revenue run rate now. It's one of Meta's fastest growing products. A click to WhatsApp specifically passed a $1.5 billion revenue run rate and is growing more than 80% per year. They talked about like here's a quick quote from Zuckerberg. We're putting the foundation in place now to scale this with key partnerships like Salesforce, which lets all businesses on their platform use WhatsApp as the main messaging service to answer customer questions, send updates, and sell directly in chat. Interestingly, WhatsApp, has 2 billion daily users now, and its fastest growing market is North America. So I'll say, like, money spent here, like, you have to spend money here, right? I mean, you have to.
Yeah, but my point, I think I don't separate the point one and point two, because to me they're basically one. So I think, okay, it's one thing to say that okay, let me backtrack. Zuckerberg likes to complain about Apple a lot. Clearly, he didn't build as valuable a company as Apple, so it's nice to complain about Apple. He still uses, I think, a MacBook and probably uses an iPhone, so that says a lot about what Apple really is. I'm sure Tim Cook does not use Facebook. So, anyways, let's putting that aside. putting that aside, I think the thing to think about is where see return on so what the ad, whether or not the ads are effective, how do you measure them, those sort of things got broken, you fix them. The thing that I'm looking at is basically look at the average revenue per person for the family of apps, right? That is going to be extremely difficult to grow, because if you look at the last 8 quarters, it's roughly in that 750, 760 range, which is where it is today, right? And the reason that it's going to be extremely hard to grow is there's only so much ads you can stuff to that base of users, which is fully saturated. I think that's the problem. I think the bigger problem basically is that the user base is saturated and there's only so much time people have. And in many ways, the pandemic probably was an anomaly because it allowed people to spend all this extraneous amounts of time on online platforms, which they no longer are spending, right? So I think that's the challenge. And I think right now, I'll just go back to what I was saying. I think the spending is not about growing. The spending is more about staying alive and not losing relevance over time. I think that's what the spending is all about. So the AI recommendation engines and all are designed just to the AI engine, it is recommending you content, but it's all about ads still, right? It's recommending you
Oh yeah,
content
all
so that
about
it
that,
can.
right? The
It's
longer
all
you
about
give,
ad.
you recommend good content to people stay on and they can see more ads.
That's all it's about. So it's
100%.
and
Yep.
I think the measurement angle is I think secondary in my opinion,
Sure.
because it's only so much you can take this. So right now it's $7.50. In Q3 of 20 it was $6 something, and Q4 was $8.60, right? I mean, maybe you can increase it by $1, and over so many billions of people it makes a difference. But it's, I think, the combination of saturated user base, so much time, and tough competition, a lot of competition in the environment, which is making it just requiring all these investments. And um, yeah, that's my take. I think it's basically about maintaining, not growing. Right? It's trying to maintain the 750, 780. Maybe go to $8. $8 from 750, and it's not about going. There's no way it goes from 8 to 16. Is the other way I'm putting it. You can't take the average is not going to go to 16 for the family of apps.
Yeah, probably. Well, I don't. I still think they have optionality where you can tie commerce right into the platforms. We'll see. We'll see. I don't want to like necessarily put a cap on it or anything. Say it can't reach a certain number. I
I am
think
putting a
the
cap.
the long tail of like possibilities, like I do think that's in there somewhere. But let's talk about the metaverse. This is probably where I messed up. So this is where I feel like, in retrospect, I obviously did not see this at the time, unfortunately, but about a year ago, when they changed the company's name, they changed the ticker and said, this is where we're going in the future. That should have been like, well, this changes the thesis. And I knew it did, but I don't think I didn't give enough credit, or it was, I just, maybe because I held shares, like my bias was too strong. I'm not sure, but this is where my faith in Zuckerberg grows thin. This just seems like a long, cruel march of throwing money at a solution for a problem that I don't even think most people believe exists. Look, it is this quarter they did announce partnerships with the likes of Microsoft, Adobe, Autodesk, and Zoom to be integrated into Oculus. And those are important apps that the next computing platform will clearly need to incorporate. Still, it just seems like such a lofty goal. Like Zuckerberg makes statements like this, right? He goes, this from the conference call. There are 200 million people who get new PCs every year, mostly for work. Our goal for the Quest Pro line over the next several years is to enable more and more of these people to get their work done in virtual and mixed reality, eventually even better than they could on PCs. That just seems like a very tall, very ambitious order that I just don't see. Now again, we talked about like where all their money is going. This is not where all the money is going. And I think there might be like some confusion on that note, but a lot of money is going here, right? I mean, we talked about R&D, and a lot of that R&D was to here.
Yeah.
So
No. Yeah. So I think 50% of the money is going here. If I have to say, I would say 50% is going playing catch up. with TikTok and company. 50% of the money is going here. Uh, that would be my guess. Look, so if you're Zuckerberg, what do you do? Basically, I think if my thesis is this is the Yahoo is correct, which probably what he thinks it is, then to be not the Yahoo, you have to invent the next thing. Otherwise, you are the Yahoo. Yeah, I think that's the problem that they've got. It's so I think at a high level, Facebook as a company is probably it's as he has acknowledged now that they don't control the tech stack. They basically don't control a lot of the experience, right? So they're working through the gateways of Google and Apple, and those are the two most valuable gateways that you have. You don't control and because you don't control the gateways, you don't control the user experience. You don't have uh, a lot of say. It's not just about whether they got dinged in how many ads they can show or how they can track users, and whether they can continue violating users' privacy and things like that. It's not that. It's just they don't
Yeah,
have the tech
absolutely. They
chops.
don't control the gateway, like you said, and
Yeah,
he wants to control the next gateway, and I just
he wants to control the next gateway, and I think that in his
it
position,
makes
that's what you'd
sense
want
in
to do.
theory. It makes sense in
In
theory.
theory,
Yeah,
yes, it makes sense in theory, I think, and
but
in
will
my
it work in
opinion,
real
that
life?
is probably what we don't know. He doesn't know, I think, but I think he has no choice, is what I'm saying. Because in my mind, like if you are an app, you become irrelevant at some time, basically. That is the story of apps. They become irrelevant over time because you can't evolve an app to become the new thing. Something new shows up, it becomes the one. That's why being a platform owner through which you purvey apps is very useful because you can keep purveying the new thing. The other thing that happens to app owners is that because you're only innovating typically at one layer, you don't control the other layers of technology. Your technology landscape knowledge is also narrower, right? Your ability to influence how technology moves across different spectrums is also narrower. That's what
I'd
he's
have to
trying to
think about that.
change.
I'd have to. So, what do you think that about apps again? Like, if you're an app, like
Well, your apps, I think, have limited like apps have limited lifetime because
I would say
apps are in.
the vast majority, that's true. But there are a few exceptional ones that seem to maybe transcend that.
So which app can you think of that has existed for, which app do you think of has existed for 10, 15 years? And you can take a very broad view of
Well,
what's an app.
I mean, I feel that Microsoft Excel, Photoshop,
E-
like I'm just YouTube.
enterprise,
Would you consider YouTube?
enterprise. So most of the stuff that you just mentioned have very deep enterprise roots.
Right, but it's still apps.
Yeah, but the enterprise apps have much longer legs than consumer apps change
Would you consider
shape.
YouTube? YouTube is an app?
Yeah, YouTube is an app, has been around for 10 years now, and
Still going strong, which we'll
still
talk
going
about in a
strong.
second. What
Yeah,
a
so in a
great,
second. Yeah, but I
great
think
segue.
it is. I think messaging apps, messaging platforms. We have seen so many of them come and go. And I think it's wrong to think that network effects are super strong. That's something that feeds and creates strength. I mean, MySpace was pretty big in its time. For its time, Orkut was pretty big for its time,
Yeah, MySpace was
and
pretty big, but it's not even close in comparison on the scale that Facebook is, or Instagram is, or Messenger, or
yeah,
what.
yeah. So I just think that uh, I think he's right to want to control platform because I think he knows that apps probably do not live for that long. That's my view, and
So
so for interestingly, for example, right, is that here's the way to think about it, right? So uh, WhatsApp is very popular in India, but guess which company is growing, very strongly right now in India? That's a company called Apple. So you see, this is the problem, right? I mean, I think free stuff is, people use free stuff for some time, and then they're using it because, well, they don't have access to the nice blue looking thing. When the blue looking thing becomes available, they just change to the blue because it's status symbol, right? They don't, status symbol matters to a lot of
sure.
people. So anyways, but I think let's talk about metaverse.
Well,
And
hold on. So, like, I just want to like my line has always been, if the family of apps stays strong, showing positive user growth, good engagement trends, everything else can be worked out. I at this point in time, I think that's true. Look, a year ago, I remember right after the big Meta like analyst day where they talked about changing the name of the company and their metaverse vision and everything like that. I was doing a Twitter space and Trevor Scott was on. If you don't know him on Twitter, he's a great investor and he had a big position in Facebook and he said it. This changes the thesis. I'm out. And I took the other, I took the other way. I held on to my shares. He made the right choice from that point on. I can't go back in time, right? And shareholders can't go back in time to their and change the decision they made. I do think from this point on, given the user growth, given the engagement trends, I think the right answer is to hold on shares at this point. Yes, the value, we can talk about we don't even need to talk about the valuation because earnings are coming down so much. I don't even think it's too relevant. I just think like this, the family of apps is a big money maker. And as long as that stays strong and it doesn't show signs of cracking, I think you hold on to your shares from there. But we can move on to Alphabet. Unless you want to rebut that.
No, yeah. So right now, in my views, Meta is basically like you're making a bet that the free cash flow is going to come back, and if the free cash flow even comes back to half of what it used to be, which probably would be like a pretty normal. I mean, some of the the operating margins that they had was ridiculous and it was unsustainable. If they get to half of that and they slowly sort of maintain that for some time, I think it's probably at some point fairly valued. So I wouldn't argue. Is this a stock I'm rushing to buy? No.
Yeah.
I would not be rushing. This is not a stock that I would rush to buy at all. But yeah, I'd maybe in a high risk basket. That's what I think about it. But I have one comment about that graph that you put. I find so that they curiously, I think they always do this. If they give you the family of daily active users, right? And that number seems to be trending up. Then if you look at the sort of the Facebook daily active users numbers, they provide that separately. And it seems like basically they've held pretty steady in US, Canada, and Europe. Most of their gains in numbers, though, seems to be coming from places where are not very heavily revenue generating. So the rest of the world, Asia Pacific, and things like that. Which is what I was alluding to before, is that there's a bit of an element of saturation that they're dealing with, which isn't surprising at all.
No, not at all. Not for that scale, not at all.
Yeah.
Okay, so let's talk about Alphabet. Let's move on. We could probably talk about Facebook another hour. So Alphabet revenues rose 6% year over year to basically $69 billion. A lot of the slower growth was due to just lapping incredibly tough comps from last year's third quarter when revenue rose 41%. Google search revenue was up in the high single digits. YouTube ads revenue came down just a smidge. I think a lot of people were concerned about that. Google Cloud revenue, I think, grew 38% year over year. It's still contributing losses to the bottom line, but the top line still growing at a very healthy clip. Anirban, what do you think of Alphabet's quarter here?
Well, it was not a good quarter. Was my first take. So at a very high level, I think what they saw was not. I mean, as you said, they were lapping some difficult compares. This quarter again showed us that look, its Alphabet is not immune to economic downturn. It's not immune to those things, and I think we saw that. So the way to see that is the revenue growth basically stalled, and at the same time their expenses have ballooned, resulting in significant pressure in operating margins. Operating margins dropped from 32% or to 25%.
Yes,
that's pretty significant, and earnings basically went backwards by 40% or something like that.
Yeah, earnings per share fall from $1.40 to $1.06. So definitely,
yeah, a 30% ish drop. Yeah. So and free cash flow also I think went down. So I mean the results were not great. And a lot of the similar story in terms of pressures. I guess one of the things to think about here is both that's a chart. I was going to talk about Well, we can talk about this. Do you want to talk about this chart now?
I'm sorry.
Uh,
Yeah, I was trying to help you out there, but yeah, do you
yeah,
want to talk about it?
yeah. No, I could talk about this chart too. So this is an interesting chart. This just looks at the last 5 years, and it basically looks at free cash flow change over the past 5 years. So free cash flow has actually grown very nicely over this period. 160 odd percent. It's up, and in the same time, their share count is also actually down, although only modestly, about 7%. So they're buying back shares, but they're also printing shares via dilution. And share price is actually up only 70%. Normally, if assuming the starting point was close to fair value, you would expect uh, the share price to sort of track the free cash flow growth, and assuming that but you could always say that it was Alphabet stock has always been more expensive than other stocks, so probably there's an element of that that is showing. But there's something to think about is that there's a big disconnect between, and you can look at it over longer periods of time as well. There's a big disconnect now between sort of free cash flow change and price change over time. So that's something to keep in. So indirectly, you could say that if they get their costs under control, which is something that Sundar Pichai and others have mentioned in the call, then things could change. The one thing I want to point out, this is about capital allocation. And while we think that some people are doing great jobs of capital allocation, I think some management teams have a tendency to overspend. Um, you know, if you hired a lot of people and then you have to fire a lot of people, that basically just shows that you were just hiring because your revenues are going up, and now you're firing because your revenues are going down, right? It's just a bad look, and it's just poor capital allocation. And it's a type of capital allocation that you're doing. So yeah, that's one thing. The final thing at a very high level I want to mention is, much like how the Federal Reserve's interest rate hikes work, there's always a lag between the hike and the effect. This is the same sort of story with a lot of these companies that spend like crazy, right? They spent like crazy. They've overfilled their pipe with people. They've got too much capex going on. Now they're cutting back. It'll take some time for that cutbacks to work. Potentially, it'll take 1 year, 1.5 years for those things to work out. By that time, the economy probably would have recovered. So you probably get into a boom period when costs are under control and advertisers are back in full force. So that's something to keep in mind.
Yeah, you brought up a lot of interesting points. So one, I'm gonna say I didn't think it was as bad of a quarter as you did. I think they were lapping in really strong growth from last year. Really strong, 41% year over year last year. It was a strong US dollar that you had going against you too. You have some macro uncertainties out there. So given all that, I mean, I didn't think it was a good quarter. I just thought it was,
Yeah.
it was okay. It was meh.
Can,
Uh,
can I just quickly? So I didn't mean to say from a revenue growth point of view. Actually, I agree with you. It's not a bad quarter. When I said it's bad results, I'm talking about the capital allocation part, which is, if your revenue goes up 6%, you shouldn't see your operating income go down those many percentage points. That's just bad capital allocation, right? So I'm saying it's bad from that point of view. The fact that the revenue only grew so much, or 11% or 12% on a currency neutral basis, that's fine. Actually, I don't have a problem with that at all. But I think they made some bad decisions. I think it just highlights that.
that might be the case, and I think they kind of alluded to that, right, in the conference call. He goes,
Yes.
where's this quote I'm looking for? Hey,
Yeah.
I love this quote. He goes, "We've had the CEO Sundar Pichai. We've had periods of extraordinary growth, and then there are periods where I viewed it as a moment where you take the time to optimize the company to make sure we are set up for the next decade of growth ahead. I view this
Yeah.
as one of those moments." So
Yes.
I just thought it was
Yes. Yeah.
we've had those moments of extraordinary growth, almost like saying, yeah, we don't really pay attention to expenses during these
Yep.
periods of extraordinary growth, but there's times when you we got to set ourselves, we got to optimize a little bit. I do think given everything with the macro uncertainty out there, everything else we said, Philip Schindler, their chief business officer, said, how search does well in bad economic times, at least compared to other advertising. He goes, in challenging times like these, advertisers are carefully evaluating the effectiveness of their budgets. Search tends to do relatively well in such an environment, given its strong measurability and focus on delivering return on investment. It's also well suited to quickly adjust to changes in consumer behavior. So I just think, all things considered, I didn't think it was quite as bad of a quarter as you did. I think, even while they do acknowledge, like, yeah, maybe expenses are getting out of control here. And we talked about headcount for Facebook and or Meta. We can definitely talk about headcount here too. They have added 51,000 employees since, I want to say, the beginning of 2021. They were kind of asked to say, hey, on the conference call, one of the analysts asked them, like, hey, you're talking about controlling expenses here, but you've hired 51,000 employees in the last year and a half or so. Like, is this a good investment? And they kind of came back, well, talent's the most precious resource, but you know what? We're going to slow down hiring. So I think they're all saying, like, hey, we've hired a lot. We've made the hires we need to make, and we're tightening our belt right now. Is that how you took the conference call?
Yeah. So I agree with you in terms of, when I said bad quarter, I'm just talking about the bad capital allocation. All of those bad decisions that they've made, the business actually fundamentally is very strong. That part I do agree, and the search is very strong, and the power of the search engine being the gateway for ads during difficult times is very strong, right? Those are definitely things that I took across. Actually, I think if I recall, I can't find my notes where it said, but I think they said somewhere in the call that they plan to end 2023 with less people than they have now. Yeah. So
I think
I think
it was
yeah.
that. I think that was Meta, not Google.
Oh, it's Meta, not Google. Okay, maybe it
I
was.
think, but they did say they were
Yeah,
going to slow down. They were basically like, yeah, we're slowing down. We're
yeah.
slowing down.
So a couple of things I want to read out actually, because I have much better notes on this. When Sundar Pichai says we are sharpening our focus on a clear set of products and business priorities, that basically means we kind of need to tighten our belt and just control our costs. That's the way I read that. This is the common thread. The next bit is a common thread between Meta and Alphabet, although it only impacts Alphabet in a small way because of YouTube. So one of the things that they say, he says in his opening remarks, is including significant improvements to search powered by AI. So both of these companies are doing the same sort of investments. And then the next bit, he says, new ways to monetize YouTube Shorts. The fact that they're just laid side by side is a way of saying that, basically we want to make this more like TikTok, and we want to catch up to those guys, and we need to make some significant investments to get there, which will support creators and all those other things that they go on to. So that I think is an indication. Okay, so here's the headcount thing. Our Q4 headcount additions will be, sorry, this was about total additions. Our Q4 headcount additions are going to be significantly lower than that in Q3. So they're still adding, but they're going to be
But they're
less.
slowing down.
Slowing down. And moderating operating expenses in 2023, which again I think is a good indication of what's going to happen in the future, because by 2023, end of 2023, you'd expect things to maybe have normalized, and therefore when you combine better capital allocation, better cost management with improved conditions, I think you have and then the compares are going to be $1.04 of EPS, right? So you're going to compare against that.
Right.
It's going to look.
Oh yeah,
It's going to look stellar.
You're going $1.06 EPS, and you're going with a 6% revenue growth, right? So your comps next year are going to be so much easier. To your point, YouTube, just real quick, they say global viewers are now watching 700 million plus hours of YouTube content daily. To your point about shorts, that's growing 1.5 billion users every month, 30 billion daily views. They said engagement strong, and they're going to start revenue sharing on shorts early in 2023. That when they do that update will make YouTube the only platform where creators can monetize their content across short, long, and live formats at scale. So there's maybe something to that. What about Google Cloud? Revenues were 6.9 billion. That's up 38% year over year. It's reflecting significant growth in both infrastructure and platform services. They saw, still contributing an operating loss of $699 million. And Anirban, you're the expert on cloud. How's Google Cloud doing?
Actually, I thought Google Cloud's results was probably the brightest spot on their entire results. If you think about future and growth, I think that was fantastic because a couple of things. One is I believe this number was actually the growth rate was higher than last quarter's growth rate. So there's a bit of an acceleration. And when you compare that with what Azure and Microsoft, Microsoft Azure and AWS did, they actually significantly slowed down their growth rates, right? And of course, those are of a much larger base. So I mean, GCP is actually doing something right here, and it's gaining share. It looks like over others, which is great. And maybe this is the point I was making alongside Meta, is when Google is investing on data centers and it's making AI-based investments, those it can leverage across multiple different things. It can leverage for surfacing better recommendations on YouTube so that people stick around longer. It can use that to fuel Google search ads. It can also use that to drive GCP, right? So it's got multiple ways to cut the cookie, which I think is really, really useful for them. So I thought it was good. The only negative I can think of is that while the revenue is growing, the losses are also widening.
Yeah.
But maybe that's neither here. This was only a few hundred million here or there. The other thing that I think worth keeping in mind is that their total remaining performance obligations, so this is the total committed contracts that they've got, most of this is for GCP, is roughly $54 billion. 54 billion, right? That's how much contracts they've locked in. So these are going to be realized in the future, and that grew at a much higher pace than the overall revenue, right? So that grew, I think, at some 50-some%, 56, 57%. Again, for Amazon, that's double. So Amazon's remaining performance obligations is around 104. But it gives you a sense that Amazon's remaining performance obligations is about 100 billion, Google's is about 50 billion, but Google's revenue is significantly smaller. It tells you that Google has an opportunity to catch up to that scale over time, GCP. So I thought it was really bullish results. So yeah, I mean, you said I thought it was bad. I think in caveat, I think Google's results were not bad. Google's cost management is bad, but Google's results were not bad. And I think Google's basic businesses, whether it's search, whether it's YouTube, whether it's Android, and Google Play Store, and its various subscription businesses, and I think they're all as together doing well. In totality, that's what I thought.
I thought so. If we take I agree with you. I think Google Cloud has a really nice future. Just comparing the two companies we looked at tonight, or in this episode, Meta and Alphabet. Probably the most the best contrast you can give, I think, might be that, like, this quarter, Alphabet delivered $16.1 billion in free cash flow. $16.1 billion. We talked about how Meta's basically dipped to zero. And look, we gave a lot of reasons for that and how much it's going to rebound, etc. But Facebook's best quarter ever with free cash flow was about 12 billion, which was like the fourth quarter last year. I think it was the fourth quarter last year. $12 billion in free cash flow. So this is a very meh quarter for Alphabet. And they delivered $16.1 billion in free cash flow, 33% better than Meta's best more free cash flow than Meta's ever had in any quarter in their history. So I think that's probably the biggest difference you can give. Let me ask you a question. What do you think? I'm curious what you say, because I have an answer for this, but what do you think is Alphabet's biggest disruptive threat, or what is the biggest risk to Alphabet?
Well, the biggest risk to Alphabet, there's covered a few different risks. So one is, of course, regulatory risk is very big. As basically the monopoly platform gateway for mobile, I think that's the biggest risk. I think the other biggest risk is, which is the same as I think is Meta, is missing the next platform, right? So as I like to say, that all of these companies are basically waiting for Apple to show its hand as to what they're working on, that decides what the next platform is. And they're all going to, the question is who's going to be the fast follower here. I think that's the other big risk is to a lot of their business currently depends on uh, controlling platforms. Those I think are the biggest risk. Although again, I'll caveat that. I mean, if you still need to do search, and as long as the paradigm for search doesn't change, it's a pretty strong position to be in. So
What so
I don't know.
okay, so this is what about Apple? Like the money it pays Apple to be the default search engine on Safari. So I'm showing a headline here. Google estimated to be paying $15 billion. That was for this year to remain the default search engine on Safari. Is this a risk for Alphabet? Like what if Apple decides like they say, hey, we want 25 billion next year, and Alphabet says no. If that were to happen, what happens? Like, does Apple create its own search engine, or do they buy like a small one like DuckDuckGo, or do they court offers from Microsoft for Bing? Is that a risk for Alphabet?
Nah, I don't think so. I think this is like a traffic acquisition cost. This is really a small amount, right? I mean, if you think about it, like I mean, basically, Google is paying TAC to a lot of people. So traffic acquisition cost it pays to a lot of other entities. It's paying to basically acquire traffic. I mean, its total TAC this quarter was what, $12 billion, right? So it's probably paying the order of like 40-50 billion dollars of TAC. Is it a big deal? No, because I mean, there's no. I think Google is so far ahead in search, so dominant in search, and it would take a lot of work to recreate that. And also, it's not the core competency of a company like Apple. So, who can recreate search? There are only a few people that can do it, and its question is it worth their dollars? And it's not really worth their dollars in that sense. So it's like I don't know. It's a um, nice relationship they've got going that hey, I want to make most of my money off devices that I sell to people and subscriptions that I sell to people. You want to make most of your money on ads. I only want to make a small amount of money on ads in my little system. It doesn't affect you. They're kind of like happy with each other that way. Yeah. So
All
I
right.
don't think of that
I think that's
as a risk at all.
I think I mostly agree with you. I do wonder what would happen if something were to happen with that relationship. All right. And second of all, I want to ask you, like, we've talked about Meta cutting back costs next year. We talked about Alphabet, how they need to tighten their belt. Is big tech getting too soft? Like, I don't know if you remember, but like after the 2000 bubble popped, there were stories like Microsoft was giving away free towels in their locker room and free sodas, and they had to cut all that stuff out. And I wonder, do you think big tech's going through something like that now? We've all seen those like TikTok videos where employees of one of the big tech companies are like a day in the life of, and they're like getting smoothies from the smoothie machine and frappuccinos from the frappuccino machine and a cocktail after work at the company bar, going to the rooftop vista overlooking San Francisco. And I saw this tweet the other day from Dan McMurphy on Twitter. He goes, true story. Earlier this year, he's talking about Facebook. Earlier this year, when the stock was getting smashed, I was at an event with a Facebook manager, and I asked him if sentiment was off due to stock performance. So he whips out his internal Facebook channel. It was 100% upset comments due to the cancellation of employee laundry service. Is big tech too soft?
Yeah, so I think I agree with you. So I think I would separate this. I think there are indisciplined spenders. So Meta is one of them. I still don't have a very good handle on how actually Amazon decides to spend what it spends, but most of it spends is on physical assets. So that's a different type of spend.
Amazon might be the
Uh,
exception, I think. Amazon might be the exception.
well, the exception, there was only one exception in my mind in terms of how to generate how to deploy capital, and that's Apple, right? Because I mean, if you think about a free cash flow generation, Google did
They
60
generate so much
billion.
free cash flow, it doesn't matter to them. But do you still think like maybe there's a lot of expenses there too? No, like
No,
the
they're
beautiful
very disciplined. So,
campus. They're
no, yes, there's a beautiful campus, but if you look at the total capex spend of of Apple as a company, it is there's something to be learned from Tim Cook and his management and his approach to deploying capital. You can generate so you know It's not that these other companies do not generate revenue. It's that they think that spending a lot of money results in more revenue and more operating income. It actually does not, because the delta that you get from spending these hundreds of billions of dollars actually becomes smaller and smaller, right? The other way I would like to say is, can I go back to another favorite company of mine? If you look at the capex spend of Meta, and it would seem like they're building cars, but they're GM, but it's not, because Tesla has less capex spend than Meta. How is that possible? You know, so I think there's something here about how the R&D expense of these, some of these Meta and Google work. And I think, basically Sundar Pichai is basically saying, yes, we've got this wrong and we got to fix this, because there's no reason, given the level of revenue that Alphabet generates, that Alphabet's free cash flow shouldn't be $80-85 billion, right? How come Apple could grow its revenue, its free cash flow 20%, whereas, year over year, whereas Google's is shrinking? It just is bad capital management, is basically the, I think, the story, which is, and spending on laundry and parties and God knows what, I think there is a bit of that, and there's a lot to be said about disciplined, capital expenditure, whether it's on our, you can hire all the engineers you want, but how many good engineers actually exist? It's not that you spend hundreds of millions of dollars and you're going to get all the, you're going to get more engineers.
Right. No, I mean, talent. Yeah. Talent's a finite resource too. Right. So
there's talent, and good talent, great talent is a very, very finite resource. So I think getting these great people and keeping them around and, cultivating them, or looking for that great talent elsewhere from the usual channels is what I think is I think, yeah. So I think that's the thing. I mean, still, 60-70 billion dollars of free cash flow is a lot of free cash flow.
It is a lot of free cash flow. Well, Anirban, thanks so much for joining me today to talk about these two companies. If you're interested more in following me or Anirban, you can find us on Twitter, or you can find us on 7investing.com. For my co-host, Anirban Mahanti, I'm Matthew Cochrane, and we're here to help you and to empower you to invest in your future. Have a great day, everyone.